Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we're sharing 3 stories. First up, San Francisco Fed President Mary Daly has just signaled that interest rate cuts could come much faster than expected, calling every upcoming meeting live due to a cracking US job market. Then we'll break down a $2.6 trillion megadeal frenzy where an AI arms race is fueling some truly insane valuations like XAI's 150 times revenue multiple as private equity's $2 trillion re-enters the game. And finally, we'll investigate why the Bureau of Labor Statistics just erased 258,000 jobs from its records and how a plunging 43% survey response rate is shaking confidence in our most critical economic data. A top Federal Reserve official just sent a jolt through the markets with 3 words: "I can't wait forever." Now, this isn't just an off-the-cuff remark. It's a powerful monetary policy tool known as forward guidance. The Federal Reserve strategically uses public statements like this to signal its future intentions, shaping market expectations and influencing economic behavior before they even touch interest rates. Believe it or not, research shows that investors react to specific sentences in these speeches almost instantly, and that's exactly what we're seeing here. That direct statement came from San Francisco Federal Reserve Bank President Mary Daly, signaling that the era of holding interest rates steady is coming to a rapid close. The reason? A US job market that is showing serious signs of cracking. A recent report showed employers added a meager 73,000 jobs. But the real surprise came from massive revisions to previous data, which revealed that only 33,000 jobs were created in the 2 prior months combined. You might be wondering how the numbers can change so dramatically after the fact. So the thing is, the initial job numbers from the Bureau of Labor Statistics are based on surveys that aren't fully complete. As more data comes in over the following weeks, they revise the numbers for accuracy. These data lags make the Fed's job incredibly difficult, since they're trying to make real-time, data-driven decisions using information that can fundamentally change a month or 2 later. Daly calls it evidence after piece of evidence that the labour market is softening significantly. And she's not just talking about that one jobs report. The Fed actually uses what it calls a broad dashboard of economic measures because those headline numbers can be misleading. They use innovative tools like the Weekly Economic Index, which pulls from 10 different high-frequency indicators, covering everything from consumer behavior to production. This gives them a much more nuanced, real-time pulse on the economy, and it's this entire dashboard, not just one number, that is flashing warning signs. But that's not the whole picture. The real turning point is Daly putting a far more aggressive scenario on the table, stating, "I think the more likely thing is that we might have to do more than 2. She now considers every single upcoming Fed meeting a live meeting for a potential rate cut. This situation presents a fascinating duality. On one side, you have quantitative models, like the famous Taylor rule, which provide a systematic, data-based framework for setting interest rates designed to be a safeguard against emotion. While on the other, you have the human judgment of a policymaker like Mary Daly, who is looking at the same data and feeling that the models are too slow. Daly warns that if the Fed waits for absolute certainty on inflation, a process that could take 6 to 12 months, it will for sure be too late to act. In her words, current policy is becoming increasingly not aligned with the economic reality on the ground. This is the ultimate risk of relying too heavily on rigid models. As we saw during past crises, strict adherence to a model can lead to a response that is too timid and too late. What Daly is signaling is that her human judgment is overriding the wait-and-see approach, a subjective move that carries its own risks, but one she clearly feels is necessary. Her most powerful statement, however, reveals just how close a major policy shift is. Referring to the Fed's last decision to hold rates, Daly declared, "I am increasingly less comfortable with making that decision again and again." The message is clear. The Fed's patience is wearing thin. The only question left is what happens when it finally runs out. Now, while the Fed is debating when to open the monetary floodgates, the corporate world isn't waiting around. The number of corporate deals is actually falling, but the money changing hands has exploded. Global deal making just smashed through $2.6 trillion, a 28% surge in value, even as the number of transactions dropped 16%. This isn't just a market shift, it's a fundamental consolidation of power. This trend is what experts call the megadeal paradox. With fewer, bigger players, the risk of reduced competition, higher prices, and less choice for you, the consumer, goes way up. And you can bet regulators are watching. Both in the US and Europe, antitrust bodies are scrutinizing these massive deals much more closely, trying to figure out if they stifle innovation or create monopolies. This isn't a market of many small moves. This is a battlefield of giants. We're talking about blockbuster mega deals, each valued at over $10 billion. Deals like Union Pacific's proposed $85 billion acquisition of its rival Norfolk Southern, like OpenAI's massive $40 billion funding round, and Palo Alto Network's $25 billion buyout of cybersecurity firm CyberArk. What really brought this to a head was the realization that the real money isn't just in AI software, it's flowing into what's called the pick and shovel economy of AI. To make AI work, you need massive data centers, incredible amounts of power, advanced cooling systems, and ironclad security. That's why we're seeing this ripple effect. In fact, Data Center A deals alone topped $73 billion last year, all to build the backbone for this AI revolution. One core driver is fueling this fire: artificial intelligence. According to one top global strategist, corporate clients are desperate not to be left behind in that race, and that fear is driving a frenzy of activity to acquire new technology and talent. It's an AI arms race, paid for in cash and stock. Now, get this, the prices being paid are shattering all previous records. We're seeing an AI premium where AI companies are being valued at multiples that defy traditional logic. While a normal tech company might sell for 5 to 10 times its revenue, AI startups are commanding median revenue multiples of nearly 26x, with some hitting 50x. Just look at XAI, which raised money at a valuation that was 150 times its projected revenue. It's a gold rush, and companies are paying any price to get in. However, if you zoom out, you'll see another layer of strategy at play. The private equity players who are sitting on the sidelines are officially back in the game, making bold moves like the $10 billion deal to take Walgreens private. They're back now because they are sitting on an unprecedented mountain of cash, an estimated $2 trillion of uninvested capital, often called dry powder. They have to spend that money to make returns for their investors. But here's the catch. The typical private equity playbook involves aggressive cost-cutting and restructuring to boost profits quickly. Research shows this can sometimes come at the expense of long-term innovation and R&D, raising serious questions about the future health of the iconic companies they acquire. While boardrooms used to be paralyzed by geopolitical uncertainty, the mood has completely shifted. The United States is the epicenter, accounting for more than half of all global activity. The message is clear. Sitting on cash is now seen as riskier than making a multi-billion-dollar bet on the future. The only question now is, in this high-stakes game of corporate chess, who gets acquired next and who gets left behind? Speaking of these staggering valuations, they're all built on a foundation of economic data. But what happens when that very foundation starts to crack? A seemingly impossible number just became reality. More than 250,000 US jobs just vanished from the official record. That's not a forecast, that's a revision. The Bureau of Labor Statistics just slashed its May and June job numbers by a combined 258,000, the biggest non-pandemic adjustment since records began. The move immediately drew fire from former President Trump, who called the figures rigged to make his administration look bad. This is where the situation takes a more complex turn. Former BLS commissioners are firing back. One, who served from 1993 to 2001, said her reaction to the rigging claims was, "That couldn't happen," stating bluntly, "The commissioner doesn't have control over what the numbers are." Interestingly enough, the BLS is designed with institutional firewalls to prevent exactly this kind of political influence. The commissioner, who is a political appointee, doesn't actually collect or sum up the data. That entire process is handled by career staff who follow strict, standardized procedures. The system is built to be independent, which is why former officials are so quick to defend its integrity. So what's the real story? Insiders point to a system under immense strain. The revisions are technically normal, but their massive scale is raising alarm bells. Analysts were already skeptical of the initial June report, which showed an unusual spike in school employment right before summer break. A major reason for these huge revisions is a phenomenon called the small business signal delay. Think about it. Large corporations have dedicated HR departments that can respond to government surveys quickly, but smaller businesses, which are often more vulnerable to economic shifts, take longer to report their numbers. So the first initial job report is heavily skewed towards big companies. The data from smaller firms trickles in later, forcing these large revisions. We're essentially getting the big picture first and the crucial details later. And the problem doesn't stop there. The reliability of the entire survey is now in question. The response rate from employers, the very source of this data, has plummeted from over 60% a decade ago to less than 43% today. Other major economies are seeing similar drops, with UK survey response rates falling to just 20%. This isn't just a US problem, it's a global survey crisis. And the BLS knows it's in a race against time. To fight this, they are trying to modernize rolling out internet self-response options to make it easier for businesses to reply. They're also exploring using alternative data sources, like private payroll records, to supplement the old survey model. It's a massive undertaking. While massive revisions have happened before, like a 143,000 job cut in a single month during the 2008 financial crisis, the current scale is rattling investors. This isn't just about one report. The BLS also revised down the jobs created in 2024 by a staggering 598th. This all boils down to a fundamental tension: the speed versus accuracy dilemma. Financial markets and the media demand this data instantly on the first Friday of the month. The BLS itself has called this initial report a quick but lower resolution snapshot. We are essentially trading precision for speed, and now we're seeing the consequences of that trade-off in these massive market-shaking revisions. This all begs the question: with the data that drives trillions in market decisions under fire and response rates in freefall, can we still trust the numbers that move our economy?
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.